And welcome to Mongo Spaces. This Tuesday evening, we're going to discuss the EABL H126 results. Rispa, maybe you can just start by telling us a bit what you do day to day at EABL, at least for the next couple of months before you exit.
Thank you, Eric. And thank you for listening to me this evening. My name is Rispa Genga Ohaga, and I am the Group CFO at East African Brewery. That means I take care of the finances, the treasury, the financial reporting, the business strategy, all of that fits under my docket. And with a great team across East Africa, that is what we do on a day-to-day basis.
Maybe to begin, now when you come in as CFO to a new company, what's your introduction like at the beginning, the first few weeks? What are usually things that you want to check off the list and just make sure that you have a firm grasp on as you start on a new role?
I'm a big believer in observing before you say anything and put out expectations, because you're coming into a new space. You don't know what you find, and you really just have to invest the time in first understanding and listening. And particularly when I came into this role, I came from banking, 11 years of banking, and then I came into FMCG and alcoholic beverages, of which I knew very little. And so it was important to recognize that I bring certain skills, but I have to first stop and listen and understand. And then only then can I then say, what is it that I want to deliver? What value do I bring? Having said that, you also have to come in with what is my strength and play from a point of strength. So I always know I've come in with some strength, but I also don't know everything. And most important always is, how do I make sure that I surround myself with the right people? And then I focus on growing my knowledge so that I can be a better leader.
From your reflection, usually in an FMCG, what are some of the key things a new CFO should maybe pay attention to as they start a new role? And what are some of the key skills that they should have developed, at least if you want to be CFO in the future?
I think first you must understand the business, because if you don't understand the business you're in, then, you are in danger of focusing on the wrong things. So just really getting down to the basics of how does this work before I even get to the numbers. Then for me, once you've really understood the business, then you're able to play your role. From a skills perspective, I always say start with the basics. The things that will get you to jail are the basic financial controls, which you learn almost in year one. If you miss something in the basic fundamental, then, that just takes away your credibility in everything that you know. Fundamentals of what do you check for to know that your income statement is fine, your balance sheet is where it should be. So having enough knowledge to be able to credibly speak to those financial statements to drive the business. And then finally, for me, it's always about leadership. You don't know everything yourself. Who do you have around you, and how do you bring the team together so that you're able to deliver through them?
I'll come back to some of your reflections because I expect to have a lot of them. So back to the results, you posted 8% growth in top line. Your net sales are up, I think 11%. You can give us a bit of flavor to what drove that growth in sales. I think it's one of the strongest I've seen in a while. Or what was the underlying drive?
A big driver of this is volume growth. With the 11% revenue growth, 8% is volume growth, which for the first time we are registering this level of volume growth in a long, long while. I think last year we're very proud of 2% growth. So you can imagine coming in at 8% is very, very positive for us, which means that product is going out and volumes are going out, which is a good sign of long-term business strength. That is driven by two things. One, over the years have had significant increases in excise, and that has really dented our ability to grow volumes, because when you get the excise increase, then you have to price it in. That means the product is not as affordable, and therefore customers can't buy as much, and therefore you have contraction in your top line and in your volumes. With the recent more positive changes in excise, we've been then able to at least hold price so that then you're not increasing prices as frequently, and then people are able to buy more product. The second piece is around innovation. We've done quite a lot around innovation since we built our innovation hub at the microbrewery in Ruaraka, just next to our office there. That has allowed us to experiment and bring out products that are attractive to consumers, and then consumers have then been able to buy quite a lot. A case in point is Serengeti lemon in Tanzania has been a complete standout. Uganda Warage lemon and ginger, Kenya cane lemon and ginger flavors have really taken off very well. Manyata cider that's really taken off. So our innovation engine, being able to roll out new products that are attractive to consumers, has also supported our growth. And then the final thing is we've seen quite a strong resurgence in Tanzania. Tanzania in Kenya shillings terms growing 44% is huge. But also we'd come from quite a challenging inflationary period during which price taking also saw volumes go down. And in the last year, again, we focused on executing better, on being present to our consumers and ensuring we have the product offering that is attractive to them. And that has seen us bring back Tanzania as well. And that's what has shown up as an 11% growth in this year. A really strong performance, very well anchored on our strategy.
When you have such a strong performance in H1, it sets up nicely for H2, because I think H1 is where you have this festive season, and that's when it's one of your strongest parts of the year.
Absolutely. Historically, the first half tends to be anywhere between 60 to 65% of our performance. So you miss half one, you've missed the boat entirely. So that tends to be the shape of the two things. Delivering a strong H1 helps us weather whatever may come in half two, but it's also very strong because that is when you do have your big peak, which is the Christmas season.
You have a very good finger on how the consumer is doing. From a volume growth of 8%, then how does that reflect on the consumer? You say the excess duty has been quite a bit of a hindrance to the consumer, a bit of pressure from taxes. Disposable income have been having a bit of a hit. NSSF rates going up from February. From your discussions with on-the-ground people in consumer, your supply chain, what are they saying about how the Kenyan consumer is doing?
I think it's twofold. First, when you look at Kenya, Uganda, Tanzania, Kenya is in growth, and particularly in the second quarter. In the second quarter, Kenya grew 7%, but the first quarter was a bit tough. So net, Kenya is growing the slowest of the three countries, but still a very positive delivery given just how many headwinds there are. But having said that, we are seeing growth in all segments. So the customers are not all behaving the same way. So we're saying premium has continued to grow very strongly at around 8%. Mainstream growing about 17%. I think it's value where we are seeing some level of down trading. And we've seen in this market, 60% of consumption is illicit. So it looks like the lower end of the consumer cohort is feeling the pain a lot more. And that means that is dropping off into illicit. But what we're doing around that is just looking at how can we make our products more accessible so that people can be able to opt for them as opposed to illicit. And also, how do we continue to have the conversations with government around battling the spread of illicit?
And then you reflect about that first half. When you look regionally, the performance was quite strong. So maybe you can reiterate again how Uganda and Tanzania performed versus Kenya again. And then in the context of there were elections in Tanzania in the first half also. And I think Uganda was preparing for elections in just after you closed. So I think there was a bit of that. And then also Kenya has elections next year. How do those usually affect your performance regionally? And then you can reflect a bit on how H1 was for the regions.
Well, as I said, Kenya a bit slower than the others, although we're encouraged by quarter two, which was very strong. But looking at Uganda at an organic level grew 9%. Pretty good, I would say. Uganda's currency has been strong. And I think that Uganda tends to be quite food sufficient. So even when there's inflation, they guys have enough food, and therefore that kind of helps the situation. For Tanzania, in Kenya shilling terms, they've grown 44%, but organically 35%. Still exceptionally strong. As I said, we came off quite a tough almost 2 years. So we'd started the recovery on Tanzania in F25, and coming into 26, we then really just leveled off and took off quite strongly. The growth is in beer and in spirits. And as I said, innovation played a big role. We previously just had 2 brands of beer in Tanzania. We're now able to have quite a wider portfolio to play with. We also got mainstream spirits in Tanzania now, in addition to premium spirits. So there's growth across the piece in Tanzania. Now, in both countries, interestingly enough, even with Tanzanian election, we didn't really see a huge disruption in business. And I guess that is a lesson for us in Kenya, that we should have our democracy, absolutely. But how do we make sure that the whole economy doesn't grind to a halt? Because that has a knock-on effect. So we're able to see Tanzania still power ahead. And also Uganda, we've seen them continue to power ahead from a consumption perspective.
Would you want to share a little bit more on Tanzania and how the election actually impacted business?
I think we all know there was a season when there was no internet. Therefore, we had to depend on a very strong BCP to ensure that where you can ship ahead, can you ship ahead before the election and make sure you've got products out there. And then the days when you had to close because of instability, then you're able to ride those through. And once you're able to trade again, then you trade again. And really, that's how we run it. So there was disruption, but I think we were proactive. We didn't see it coming, but I think we always manage a crisis by making sure we're fully prepared. And so that was what we did, was saying, supposing we're out for 10 days, how do we make sure that then there's no shortage? What we can do is that make sure that we enable supply. The product is out there. If consumers want to access it, then they're able to access it. And I think that is what helped our situation. So when internet and banking and everything came back, there wasn't a shortage in the shops. We're able to resume and go back. And very soon after that was Christmas. So we're able to pick up without too much disruption.
When you think about volume growth, that was a strong 8%. I think pricing must be a smaller driver there. Do you feel like you press the price button a bit much and consumers hitting that peak where they can't take price anymore? And then also in terms of mix, are you seeing consumers also trade down a little bit, trade up in terms of how they're feeling? And then also, of course, you can talk a little bit about the challenge that is posed by illicits usually.
You've asked so many questions.
We can start slowly. Let's start with the volume and price mix and how that played out in H1.
So as I said, that the biggest driver is volume. We barely took any price across our markets. There's volume and then there's innovation. So if you bring in an innovation that gives you good volume and gives you good margin, that's a good thing. And so innovation really played a really big part. I think a new product, which our strategic pillar is shaping new frontiers, grew 63% year on year. Innovation has played a big part there. In terms of price, we really didn't take price. In Kenya, maybe only on the premium spirits, and where the hit on taxes meant that we needed to take price on that. But other than that, there was hardly any price taking. We're able to focus on productivity, making sure that wherever we experienced inflation, like neutral spirit had significant inflation. So in Uganda, we had inflation on barley and sorghum, but we're able to find opportunities to be more efficient in order to ensure that then we don't pass that on to the customer. And we do that through how we buy, efficiency in our production processes, making sure that we are as efficient as possible, also in our logistics handling. And we're able to save quite a bit that offsets the impact of inflation. So there's hardly any pricing, volume-driven growth, driven by innovation as well. And then we manage to offset pressure on the cost line through productivity.
The next question I was asking is about how the consumers trading down, and then if are they moving out of your portfolio then into illicit because of price challenges. This is something that you emphasize a lot, the challenge of illicits and how pushing up excess duty can also price out some consumers and push them into the hands of illicits now, which have kind of an impact on consumer health.
And highlighted earlier, just across the pillars, we were in growth. The only place where we saw a bit of pressure was on the value end, on the lower category, and we felt that those consumers were under some pressure. And if you look at the Euromoney studies that were done in the last year, I think a few years ago, the proportion of illicit was 50%. That's gone down to 60%. So 60% of alcohol being drunk is informal. And a lot of it is, let me call it illicit, because you don't know what's in there. And therefore, when you consume it, it's quite harmful to your health. So we are seeing pressure. But we do recognize the role of policy in reviewing the excise regime, because then they're going to find products. If you make it safe and accessible and the taxes are paid back to the exchequer, I think that's the right thing to do. And that's what we've really been focused on. But we've seen a little bit more of the spread of illicit and also of those consumers dropping off. There's work, I think, being done by government to address that. And we are still hoping that there's more work on the excise front. So we were happy that there was a reduction, but still where we are, if I look at shilling for shilling, we are still nearly twice the rate of excise in Uganda and Tanzania on beer. And on spirits, we are again still higher. So there's still room to do something so that we reduce the impact of illicit on consumers.
Let's go just below the net sales. We have a look at gross profit was up around 15%. Your operating costs are flat year on year when you exclude the FX. Could you speak a bit about that and what some of the things that you're doing to make sure that revenues are almost rising faster than costs?
I think twofold. One, if you look at our gross margin, it improved from 41.4% to 42.8%. That's 137 basis points, which is very strong. Helped by two things. One is the productivity I've talked about, countering the impact of inflation with quite a lot of productivity, efficiency in our operations, being more keen on how and where we're buying to ensure we get the best prices. But also the impact of volume is not just on top line, it's also on fixed cost absorption. When you run a factory, the factory is fixed, you can't take it anywhere. So the more you produce, the less cost per unit, and therefore the better profitability you have. So that also helps us because it's only the variable cost that grows with additional production. So you see that benefit coming in, and that helps us with the margin expansion and the gross profit growth that you're seeing there. And then going further down onto the expenses, we held expenses flat, pretty much maybe just about 100 million growth in year, but in percentage terms flat. And again, being really very focused on spend, where we're spending, how we're spending. There are things we have to spend on. You have to invest behind the brands. But again, asking, do we need to spend this? So we've been able to then hold expenses flat. We also didn't have any significant one-off hits in this half. So that was helpful in keeping the performance strong. And at the end of the day, the PBT percentage to top line improved by 393 basis points from last year, 17.9% to 21.8%.
When you spoke about one-offs, and I think one of those hits is always from tax disputes and cases. Was anything in H1 that you wanted to highlight, or is it a clean H1?
Is it ever? We always have gremlins, but I think there wasn't anything unusual. With the taxes, we always try and make sure that we make a really prudent view of outstanding matters. Tax is a big risk for us, both from the policy side and then also from interpretations. And there are quite a lot of disputes, not just in Kenya, but across the region. So also just we try and make really prudent judgments on those. But that's can be extremely challenging. Sometimes you question the rulings as to whether that really makes sense. But we keep on pushing hard. And to be fair, the regulators have been very engaging to make sure that the interpretations are sensible, that we put our cases forward and that we're listened to. But having said that, that still comes through on occasion as something to watch out for our business.
Curious question, and you probably have to answer it. But do you feel like the average CFO spends a bit too much time with the taxes and all that? They sometimes have a little time like to spend on core business usually. This is more like a general observation. Or is it something that maybe Kerry and the government can also help in terms of simplifying that so that you spend more time on the real business of doing business?
I wish it would be that way. But I think it's also the nature of the business that we're in, but also there are things that could be less, I think, problematic. Some things should really just be straightforward, but when it comes to matters of interpretation, then it does take time. So I think there is some work there. It is more intense in our industry and also in manufacturing as a whole. There's so many tax heads, there's so many interpretations around them, and sometimes how the law is written leaves a lot to be questioned. And sometimes you do have to test it through the judicial process to get the right interpretation. So can it be cleaner? Absolutely. Definitely can be cleaner. And that would be beneficial because then we would spend more time on strategy and on making more money and paying more taxes from making money.
Definitely. And I think one of the highlights is also the dealings that you had with the excess duty, I think the daily excess duty. Could you speak a bit about that, how that was and your reflections around it and how that clip went viral?
That was one conversation we had, which there was just by way of background, a change to the excise regime that then required us to remit the duties on a daily basis. So as soon as you removed an item from the storehouse, then excise, which is a consumption tax, became due and payable. And we talked about it, different business journalists amplified that voice, and I think the policymakers were amenable to relooking at it, and they changed it last year. Because what it did is then intra-month you were ending up in overdraft position because you're prepaying the tax, which was very, very painful and very impactful on our results. They listened to that and were able to change it to once a month. It is close to the month end. I wish they'd move it to be more aligned with other markets where it is later in the month. But they have changed it to once a month, and that helps that overdraft position. So I think voicing and having you guys like you amplifying that voice does make a difference. That was one, I think that was a great success.
For me, that stood out as one of the key reflections from your tenure that definitely I think people should be aware of. Like, it's okay to speak out on some issues and that the policymakers can also listen to them and actually make changes.
Yes, absolutely.
But when you look at the cash position, I think there's been a bit of improvement on that end, working capital position. You can speak to that and maybe how that change in exercise also affected the H1 versus the previous year. And also if you have any insights on, have you had any inclination at what might be coming up in the finance bill at 2026, if any?
Cash has been strong. And as I said, the biggest thing about the issue of the daily excess payment was the impact on our cash cycle. And so your cash conversion rate was off and you ended up borrowing intra-month, and also your working capital then was not very strong. So you do see an increase in our creditors as a result of that tax only being due in the next month rather than on a day-to-day basis. So you can see that showing up in the numbers, but on the contrary, sitting in cash, which then gets paid a bit later. But you'd have lost out on the cash because you had to pay a lot earlier. That has helped quite a bit. From cash, again, you generate cash from running the business. So running the business and growing gives us more cash, which we are then able to deploy. And our cash conversion rate is pretty good, actually. It's over 100%, which is quite positive.
Finance bill.
It's hard to tell. There's various proposals. And I think for me, what I will say is my hope is that we continue to see an environment that is business supportive. We've been able to demonstrate that when there is stability in policy, there's listening on both sides, then business is able to generate more income, create more jobs, pay more taxes. And I think that is something we've been sharing for many years. So it's our hope that we will continue to see that. Also on the consumer side, that it's been quite a tough 2 years, especially for the Kenyan consumer, with more and more taxes and deductions. So I have heard the minister talk about giving some reprieve to the lower income earners. I do hope that they will look at that, because you want to grow the economy and you don't do that by shrinking. You do that by encouraging employment, putting money in people's pockets so that they can spend. And then industry grows and jobs are created and it's a knock-on cycle. So I'm hoping that we shall be more of an expansionist mindset. I do know that there's the real challenge of the level of debt that we carry, and that always presents very difficult choices. Again, I see the challenge, but I'm hopeful that we shall spur the economy to grow so that we can then be able to generate more taxes, create more jobs, and allow industry to make more money to pay more taxes.
So I want to double click on the cash generation so we can discuss various components of it. I think cash from operations was up around 3 billion, I think, in the first quarter. If you look at that, working capital was also good over there. When you look at that, and also net interest paid was a little bit down. I think you reduced debt also at that moment. So maybe you can speak a little bit about the cash flow. I should say the cash flow generation looked really good.
I think we're a very cash intensive business. So we've raised 25 billion from our operations. That was like 2.3 billion more than the previous year, which again is very good. We used that to pay down interest, taxes. Interest was less than last year because of the shifts we made on our balance sheet, but also the rate changes. We paid taxes about 5 billion. We bought fixed assets, mostly returnables and bottles, and we paid out dividend of about 5.5 billion. We also reduced debt by about 3 billion. So our net debt pointers at the start of the year, we started at 12.7 billion and we closed at 17.7 billion. So a strong showing on the cash front.
And then dividend, of course, is one of your cash components. You did hike dividend, 50% interim dividend. Is that does anything to do with someone acquiring someone else that we saw?
No, not at all. I think the story around dividend is, if you remember, for many years, even after 10 years ago, we were paying 3 shillings per share at interim. And then COVID came and we almost went down to 0. And then we came back slowly, 1 shilling at interim and then 2.5. And our explanation has been very consistent to the shareholders that we have been working on bringing down the level of debt that we are holding, because the business was quite vulnerable to debt, particularly when rates went up significantly. So it was important for us to level that off quite quickly. And so we prioritized that. And that's what we told shareholders. We told them when we have done that, then we will be back to a consistent dividend. So when you think about it, we should be at 4 per share by now, and it's the right level. Also, I will say from an M&A perspective, Those who run M&A know that this is something that will have really been looked out for in contracts, that one can't just go and now start extracting. There will be safeguards put in place. So none of the decisions of the board is informed by any single shareholder. The board looked at it and said, what's the right thing to do for our shareholders, given a second year of strong performance? And we had said to them that we would hold back and be conservative on dividend until we've sorted out the issue of debt post-COVID and with the high interest rates we're dealing with. So that we are all about doing things right and doing things that we're able to sustain and defend, and we're not commanded by any one person to do something, but also there are appropriate safeguards around M&A processes that make sure that one cannot benefit unduly. We still have to take care of the minority shareholders and do the right thing for them.
The dividend is pretty rich, I should say, so very commendable that you've decided to reward shareholders.
Allow me also just to say that it's an interim. The final will be determined when the final results do come out, but I think we just looked at it and said, look, we've really been tight on managing the debt, and with this performance, we've got a lot of cash. We've got very little debt, and we've told shareholders we're going to come back and pay them back. It is the right thing to do, but having said that, the second half will determine what the full year dividend will be.
In terms of investing, CapEx, OpEx, how does that look like so far in H1? Was there anything that needed investing in? And what are some of the things that you've been paying attention to in terms of maybe future expanding some production at a facility somewhere or something like that?
Again, the other thing you remember, and that also drove into dividend, etc., was that between 2020 and around 2023-24, we were in a high investment period. Even 2019, we built Kisumu factory. We expanded Uganda capacity, which is what is driving the kind of growth we're seeing. We expanded Tanzania capacity again, which is what is driving the growth we're seeing. We also invested in biomass across the two markets in Kenya and Uganda. And we also put up our microbrewery, which has become quite critical to our strategy in availing the opportunity for us to innovate really quickly. During that period, the CapEx to NSV ratio was upwards of 11 to 13%, which is elevated. The normal level before that period was about 7-8%. It's a little low right now at 5%. For the last 2 years, it's been ranging between 5 and 6%, but mostly because we're not in a high spend period, and most of what we're doing is sustaining the factory and the buying what we need to be able to get product out. So bottles, also things like kegs and cases and things like that. So that is what we need to spend on right now. That doesn't mean that will stay for a long time, but also equally linked to that, one of the things you will see from our sustainability actions is something called Project Rudisha, where now spirits bottles, which were typically one we use and dispose, we're now collecting them back and recycling, getting those cleaned and being able to reuse them helps us then not spend too much, but is also creating jobs and supporting sustainability in the environment. So there are a number of things that we've done from a shifting perspective on the CapEx, but the big thing is we've come from a high spend, high investment cycle. We may still go back to more investments as the case may be, but at the moment we are fairly comfortable that we have enough capacity.
So I wanted to check on FX. Is the stable, quote unquote, FX, has it been very helpful for you this year?
Compared to where we came from when we were taking pain after pain on FX and interest rates, this year we've had quite a bit of stability across the region. Kenya had a small loss, mostly because we have exposure to euro and pounds. And those, like, there's been some weakening of the Kenyan shilling against those, so we had a tiny loss over there. But Uganda, Tanzania have continued to strengthen. The currencies have strengthened, and that has given us a positive. We had a gain of about 100 million. So that again was the position. So balancing out those two has been helpful. But yeah, definitely an improvement from the previous years when we took a lot of pain. But also last year, half one, we had a big profit from the resurgence, the Kenyan shilling strengthening quite a bit compared to the previous year.
And then if you look at it in terms of net borrowings were down around 2.2 billion. Net finance costs down around 37%. It was also the half when you redeemed one MTN and also issued another. And then in terms of reflections on all that, the debt perspective, could you maybe share a little bit of some of your takeaways from H1 in terms of all that?
It's been quite the long journey. As I said, when we came out of COVID, one, we were expanding certain facilities that we really needed. And two, the effect of that period took a toll on our balance sheet, and we were sitting at about 58 billion worth of debt. So bringing that down to 37 billion in such a short time, I think is a very strong achievement. The second thing we've done is change the mix of fixed and floating, and that has been through the MTN programs we've gone out with. We're holding about 17 billion or about 37 billion is fixed. So that helps us in the event of volatility. Then the P&L is relatively protected from the huge impacts that we saw last time. So I think quite happy with where we are and the work we've done. Coming out to get an MTN the first time in, I think, 2001, it was tough. We see it as a good opportunity, but I think with all the failures that had been there was a lot of nervousness in the market, and it was quite a tough decision to brave it and go out there and do it. It was hugely successful, and that was quite a positive thing for us, and it helped us through the 4 years that we had it. And then we saw the opportunity again to optimize the balance sheet by having some fixed and some floating, and also recognizing that the capital markets are a good avenue for access to funding. So we then came back in late last year and were able to get a fairly decent chunk to stabilize the balance sheet for the next 5 years. And again, pushing, I think from the first time we issued, our biggest conversation is that how do we get the market to think risk pricing as opposed to just yield? Because you do need to price for risk. So we wanted to test the market, and I think we did that. And we're able to come up with a fairly decent rate and a good outcome all round. So I think that's one of the things that we've tested the market quite a bit, and hopefully it's given confidence to other companies to also come into the market and raise funding. You've seen more players coming in, and I think that's a good outcome. The capital market is vibrant and active. It's our role to open up those avenues for people to be able to invest, but also to challenge the market to price accordingly and make sure that there's a risk basis to how pricing is being done.
When you think about it, and in terms of reflecting around the MTN Safaricom forward deal after, what gives you confidence in terms of going to market fast in that regard when no one else was actually thinking of that, and then inspiring others to come on board? What are some of the reflections around the issuance of the MTN back then? And do you see a corporate bond market revival happening maybe in FY26?
One, we really did our homework. And first of all, we are big. So getting access to funding from all the banks, and especially post-COVID, there's quite a lot of uncertainty. Our funding needs were quite big. And then also just the need to balance. We need more longer-term funding. You find that the banks are bigger on working capital, short-term. Longer-term funding tends to be a bit challenging to navigate. So we looked at all our options and we felt this is a viable thing that we can do, and let's go for it. For me, I'm a firm believer in do the hard things. And secondly, you don't have to fear. I think if you've done your homework, you know what you're doing, you've had all the conversations, you've got the right advisor, then you should have all the courage to go out there and do it. Of course, there's a risk of failure. There's always a small risk. But one for me is, are we doing the right thing? Am I confident in this business, and can I put my money behind it before I ask anybody else? And then making sure that then we go out there and we do our homework and we do it right. Once we did that, I think it gave a lot of confidence. I think it still does. I do think that the two things to look out for, one is it is a space where you're out there. The kind of sentiment we put out there can make it very jittery for people to come out and participate. So we just need to manage the conversations to make sure that you don't make it difficult for people to come out onto the capital markets, particularly when people are doing the right things. You've done your homework, you're tight on your governance, and you really are doing everything you can to get it right. So I think for me, it's just managing that rhetoric. It's our market, it's our country. Having a vibrant capital markets matters, and how we speak about it is a matter of confidence. So let's do the right thing for our country, for our market, for our businesses, is what I would say. And so I think what we must not do is spook people from coming into the market. For me, I think I'm always confident that I'm big on governance. Those who know me know I spent years in audit. That means that I am exceptionally careful on ethics, integrity, and doing the right thing. And for me, it's when you go out to the market, you have to be confident that you're doing the right thing. You must check and be sure that you have applied your mind to it. And if we do that and we have good quality businesses coming out, getting the right pricing, I think it will be really good. It challenges our bankers, and they've told me I've challenged them quite a bit. it challenges them to solution for consumers and to extend credit to consumers. And I think that's what we want, is a market where if you need funding, you can get it. And if you get it, you can pay it back because the rates are sensible and you can run good business and pay back those amounts. So I think for me, it's just managing some of the rhetoric to make sure that we don't spook good players from coming out to the market to participate.
That's a really good takeaway. One takeaway I think I get from that is that due diligence really does help in terms of building confidence in making a leap of faith. So don't just make a blind leap of faith. So it's also based on good due diligence.
The conversations we had to go even to our board to tell them, look, we've done the homework. Here is what we think we can do. You know, the players are also really good. They gave us a lot of time. The pension funds, insurance companies, all the different companies spent a lot of time just talking through what we were proposing, giving us guidance on where to pitch and what would be sensible for them. So that by the time you're landing the transaction, you're going there feeling very confident, because nobody wants to go there and come out with a deal that is not fully subscribed.
Something else also, like the ones who followed you came to market through a green bond. Is this something you considered? And is it that maybe your alcoholic beverages companies find it a little harder to maybe pursue that path of being a green bond than maybe a telecoms company in that regard?
Not particularly. We thought about it. And so for us in manufacturing, if you think about the metrics around sustainability, they're not the kind of thing your typical accountant can go and confirm. Water usage, energy usage, carbon utilization, all those are really quite technical. And while we've been monitoring and reporting on this, I looked at it and I said, look, we can go green, but one, it needs a lot more time for us to be ready. So we would have to invest a lot of time. And secondly, we need to make sure that from a governance perspective, we have everything we need to meet and check and confirm all the metrics we sign up to. And I think for me, that was the thing that I was saying, I don't know if we're ready yet. And maybe being a bit of a perfectionist, but I didn't want to risk it before we were fully ready from a governance and preparedness perspective. Now we are in the process of fully implementing S1 and S2 for our business. And as I say, ours is a lot more complex. It's also not just within our premises, but also our suppliers, our vendors. It's a lot more intricate in the measurements. And so we looked at it and we said we could go this route. It's going to take a lot more time. And with transactions of this time, timing is of the essence. You wait a little longer and you could find the rate has moved and you're out. So for us, it was more of balancing how ready are we to risk that and the timing we have to go out and strike the deal at the right time. So I think it's still doable. I think it is probably easier if you're not heavily manufacturing, but I also think you can do it. And it is something that probably the person that will be sitting on this seat will probably explore.
I should say there's someone in the audience who has sent us a very specific question. Communities, they say, we can't know which company you're heading to, but can we at least know the sector?
Let me say it is not manufacturing. That's all I'll say for now.
We'll be on the lookout, of course. Maybe one more thing I might have missed. The receivables are up 22%. I think that was 4 billion-ish. Is that something we should be concerned about, or are they part of the government's many pending bills out there?
Oh, no, we don't have pending bills at all. What I will say is there are two things driving that. One, there's just the level of growth we've registered. And with that, we're very tight on our collection cycle. None of that is overdue. We've actually got a below 1% overdue level. And anything that requires provisioning is provided for. So very confident around the level of debt and the collectability. But there's about $1 billion or so there, which relates to tax stamps. You normally order only when you reach a certain threshold, and we ordered quite close to the period end. So you're holding about $1 billion of a prepayment of tax stamps sitting in that number. If you remove it, then your growth is just about 16%, not too far off from your 11% top line growth. So I'm fully comfortable with where we are on debtors.
So maybe finalizing on the bit about the business performance, when you look ahead a little bit, I know you don't give guidance, but it's a month into the new year and it's second half of the year. How's the feel around the business from your talk with your suppliers, the people around you? How is the feel around the business as you enter the second half of the year now?
I can't really say much because it's only a month, but we are focused on continuing to focus on the consumer, sustaining our momentum. But the one thing that is slightly worrying right now is the weather pattern not being proper short rains, and the current looks like there will be a drought. And if that happens, then, there's pressure on grain and grain prices. So that's the one thing that worries me. Not likely to impact this half, possibly only next year. But again, there are different things that we start to explore to manage that. So the drought does create some volatility. But other than that, so fairly positive around where we are and remaining focused on just doing what we need to do to land the outcomes we want for the year.
Are there interesting things maybe you've learned from yourself, having come from banking into FMCG? Some interesting bits that you may want to share. They don't need to be like specific facts, just a few interesting bits that you have learned over your time, in perhaps where value is produced in the country most or something like that. They don't have to be specifically related to performance and all, but some interesting bits that you've learned yourself.
I have to say, when I started, I didn't even know the difference between vodka, gin, whiskey. Husband said I'd never tasted a beer. But yeah, I think first just it was a completely new industry for me. So that was one thing. Two, visiting particularly the plant and the guys who are in the brewing space. I was surprised that we actually do that with machines. I thought you'd find a guy with a big stick stirring for them. It's just like to see that actually it's a button press and the stuff gets done. But it's just a very dynamic, very exciting, very challenging business. You have to get everything right, from the timing within which you bring in products to producing it to getting it out, because the beer you didn't take to the shop will not be drunk tomorrow. It needs to be there as and when the customer needs it. And you also can't run out of inputs to make it, but you can't also have too much of the inputs. So it's such an intricate business, but extremely exciting.
You're leaving at a time when there's a new owner, new sheriff in town. Could you speak about perhaps what Asahi, as they've communicated in terms of their plans for the company and Diageo as they exit? What are some of the reflections that perhaps you're willing to share about that bit? And the coincidence aspect of that you're leaving when they come.
No, first of all, they're not in yet. I think it's important to establish that they got into an agreement to buy. That agreement is subject to regulatory approval. That approval is still underway, so they have not said anything about what they would want to do, because you don't count the chickens before they are hatched. So this chicken is yet to be hatched. We are continuing with business as usual, as we will for now and even for the future continue to operate in the same way. All our local brands and all our Diageo brands will continue to be in the market. What I know is this is one of the biggest M&A transactions, the biggest Japanese investment in Africa. And it's the first time that Asahi is coming into Africa. And so it says a lot about the potential of this business, the potential of this region, and just about us as a company and us as a people. So I think it's a really good thing. What have they said? I think that will come once the transaction is completed in the second half of this year. Having said that, I do think it's an exciting time to go through such a transition in anyone's career. So I think it is really quite exciting. But as I say, I always had my own plans around where I need my career to go. And so that was already in train, and they just happened to meet at about the same point. But I still remain very confident in this business and even in both Diageo and Asahi as partners.
There's one small bit that Wananchi have been communicating. Someone did a quick math and noticed that the price at which the acquisition is being made is around 500 plus. And they were complaining to me, right? Can you ask a bit about the difference between 500 and 300 in the market? It's quite large. I know these are not like things that we can speak about confidently, but perhaps is there anything you can say about it at all?
No, that's a transaction between grandparents. I'm just the child here. So when the big people are talking, I sit on the side. So no, I can't say anything.
There's a quick question that has come in here. I'll read this directly. With consumers substituting towards illicit brews due to perhaps affordability, what strategic levers beyond pricing is EABL using to influence behavior and protect its consumer base?
The challenge is that when doing business, it has to be economically viable. So there's a level at which if I pay taxes, I can't even pay for my inputs. And so there's just a level where you just cannot go beyond. And we need to look at, and that's why the conversations around the tax regime, but also the conversations around enforcement, because we know that when there's strong enforcement, this goes down. When there's no, then it goes up. So it's almost a full-time job for the authorities to ensure that they are tackling this issue of illicit. It's not an EABL issue. It's a whole society issue. It's all of us issue to just do something about this. So I think best we can do is really support enforcement action. Other than that, business-wise, it has to make sense. And we are not about to cut corners around paying taxes and things like that.
Someone is asking a breakdown on Outlook. And you don't give Outlook. Someone is asking about premiumization. To give a bit of color around that and how you positioned yourself this far. And I think to add to that, is it true also Gen Zs are less interested in alcoholic beverages than other generations?
There's a question on Outlook. I won't really give an outlook, but what I will say is we are confident around this region. If you look across the world, it's hardly anybody growing their GDP at 5-6%. When you look at some of the development in Kenya, but also Uganda, the work they're doing around oil in Tanzania, infrastructure work, mining, there's just so much opportunity for growth in this region. So I remain confident in that. Around premiumization, I think we shared that we are still seeing very strong growth in premium portfolio. We grew 8%, both beer and spirits in growth. And having said that, we also recognize that the biggest part of our business is in the mainstream space. So whilst we drive premiumization, we are also big on making sure that we grow the mainstream segment as well. And I think it's just really, again, being focused on the consumer and where they are and what they need and making sure we're able to innovate and supply and cater to those needs.
We'll switch more to the reflection side. So reflecting on the journey so far, what are some of the things that have helped you shape the company? What are some of your key highlights that you stood out in terms of looking back at this journey that you've been on so far?
Maybe let me also answer with that because he's asked about cost-saving areas and whether Asahi will disrupt the way of doing things. One, I think cost savings I talked about, we look at how can we go to tender, can we negotiate with our strategic suppliers. Those are all areas that we're consistently looking at, and that has delivered some good gains. Also in our own operations, can we be more effective, less wasteful? And you'll be surprised as how much we're able to extract from better efficiency in our operations. And also areas like logistics, just thinking about how you plan the lanes and route adherence and the size of the truck and optimizing its load makes a big difference to the cost. So we have experts who are consistently looking at that, and they make sure that we extract as much savings as we can. Let me not say anything about Asahi. What I will say is that this is their first acquisition in Africa, and it's a strong business. It's a going concern. It's got a strong leadership team. It's got good people, and the results are showing. What we remain focused on is on our strategy, and we continue to do what we need to do. And I think if you also get into a business and they're doing the right things, then that's always a good thing. On my reflections on this journey, I think my reflection on this one, and actually on every other role I've held, is that if as a leader you don't impact the people, then maybe you haven't done your job. How have the people transformed in your watch? Have people grown their careers? How are they delivering? And more, I am convinced that if you care about people and they care about your work and they deliver above and beyond. So I'm immensely proud of the teams I have across East Africa, just the way that they deliver. People have grown their careers. People are delivering such high quality and they enjoy coming to work and doing what I do. And I know that we enjoy working together. So I think for me, it is in that being a leader, you really don't know everything. So how do you surround yourself with the right people? But you also give them space to grow, including letting them go to other spaces if that is what is good for their careers, and then creating space for more and more growth within. And I think that has been what we've been doing in the EABL. And it's not just about the finance team, it's also how we then impact beyond our own spaces and really create a leadership that cares, a leadership that delivers, and a leadership that makes a difference. So I think for me, that has always been the thing that I look for is, can I leave people better than I found them? Can I leave them in a space where they can also show up, deliver good work and grow their careers? And if I do that, we find that results always follow. I think my second thing is just resilience. So coming through COVID and just seeing how our business was able to be resilient, people getting into solution mode rather than focusing on problems, and just staying focused on what we can control, I think helped us navigate that season. And it was both resilience personally, as well as for the business. So that was a big learning for me. I think the third one is doing the hard things. If you think about all the things we've done, they've not been easy, but don't be afraid. What's the worst that can happen? Going out there, doing something that's never been done before and setting the stage for it to be done even better after you. And I think for me, this has really been a period of transformation, which is what I love. Resilience, but also building momentum, navigating this business through quite a volatile period, making sure we've set the foundation for a very strong future, interacting with investors and giving them confidence around our business, and then also just bringing on the MTN that we've done, really reflecting internal discipline as well as confidence externally. I think for me, with that, the only other thing I will say is it is good to leave the stage while the audience is still clapping. And I think, therefore, the timing just really works out. And any job is an assignment, and you come there, you do what you are there to do. And that usually involves impacting the business, but also impacting the people. And if you do that, I think you've served your assignment well, and you can happily move on to something different.
And what are some of your maybe advice for the person coming into your role? Just general reflections. Doesn't need to be very specific. And then also you can share a little bit about maybe some of the kind moments that you've experienced at EABL as EABL CFO. So what's the kindest thing someone has done to you while you were CFO?
My advice for the next person is to be themselves. There's no one else who can be a better you. So when I came, a lot of people found me very different from my predecessor, who was exceptional. And I just kept saying, look, I'm not going to be him, but I'll be the best me and bring my best. So I know that they will bring their best self as well. And they will shape this according to their best gifting. And that's what I'll encourage them to do. And of course, I'll encourage them to care about the people, because you just don't deliver alone as a leader. You deliver through people. And if you grow your people, then you've done your part. So I think that's what I would say. What was the second question?
The kindest thing someone has done to you.
Kindest thing, my goodness.
One or two then, if there are so many.
A lot of my staff and the guys that work with me have gone above and beyond. They working all hours to deliver the things that we need to deliver, but also looking out for each other. I feel like I have a team that really cares for each other. They will not let anybody fall off the wayside. They're always making sure that nobody gets left behind. I do think also a lot of people have been kind to me, and especially the business journalists. Your coverage has been really balanced. I don't think there's been any adversarial conversations, so that has been very helpful. And I think a lot of people have taught me. As I said, I came into this industry knowing nothing about it, so many people have come down to my level to simplify things to where then I could be able to play the part that I needed to play. So a lot of it is just people listening to my questions, even when they didn't make sense, and me saying, okay, explain it to me like a standard one child, and getting them to break it down. So I think for me, that has been really a huge, is the graciousness and the kindness within which people have handled me as a person looking in from the outside. I'm not an insider manufacturing-wise, but I've been embraced, I've been supported, and that has made my life a lot easier.
I should say your leadership shines through in terms of the competence. You're one of the most effective CFOs I've met. And for a long time, I've been saying that at some point, the exit shall come. And I'm not surprised, but at the same time, we'll definitely miss your insights at EABL. We look forward and we'll be following and waiting for that next announcement where you're going. We'll follow your journey once again there, and we'll still come knocking and asking for more interviews. But I think in terms of insights and just sharing your journey and reflections throughout the financial year has been really wonderful. So I want to give you a chance to speak to Wananchi, and then at the same time, maybe give a pitch why Wananchi should keep listening to Mwango Spaces. So you close out for us.
My goodness, you didn't pay me for that last part.
We'll talk later. You might attend.
Mine is just to thank everybody, one, for coming here today to listen to our results. As I say, this is the results of many people in EABL diligently executing every day. I say my part is to come and share the numbers, but there are many people doing amazing work to be able to allow me to deliver these results. So I want to thank everybody for coming here today, but also for the support throughout my journey. When I took this role, I was coming back to Kenya after 8 years. I don't think anybody knew who I was. And nowadays I meet so many people and they're like, you're a spa. And it's overwhelming, but I'm really grateful for the opportunity to serve, for the opportunity to impact, and even for the opportunity to have conversations like this one. I hope I've covered what you said. You said I talked to Mwananchi. It sounds like I should ask for votes. Let me leave that one to Evan. But yeah, just really gratitude and just a reminder, be kind. Just be kind. There's such a shortage of kindness and also a shortage of good leadership. And so if we just shift the dial just a little bit every day, it makes a difference to our world and to our country. And then to Mongo Spaces, I think you're doing an amazing job. And I've seen you guys grow through the years from when I started following. I've really seen immense growth, detailed analysis. You're not afraid to be challenged. If you report something and I don't think it's accurate, I challenge you. And just yourself, Charity, the entire team who come out to listen to our results. It's encouraging that you guys rose up, started this thing, and it's become so big. So well done to you guys. But also to all the other guys who, I think it's important for us as business that people help us speak about the things that need to be done. And you've done an amazing job around supporting us on matters policy and helping us voice those things out. Just to thank you guys also as well for the work that you're doing.
Thank you, and all the best in your new venture. But I would say from the bottom of my heart, I really thank you for coming and always being a regular guest, and we hope to have you more in your new role.
Thank you. Thank you very much, and have a good night, everybody.